Looking to avoid risky assets like equities in volatile times, but still want to take exposure to hot blue chip companies? But can you really take exposure to a company without actually buying the shares of the company and also ensure that the investment is safe? Yes, you can. But before I tell you how, don't forget to like and share this video and subscribe to the Moneycontrol YouTube channel. Now, we all know that there are various types of bonds that you can invest in. These are plain vanilla bonds, tax-free AAA rated bonds and perpetual bonds that offer relatively high returns. Bonds are available across credit quality as well as across maturities, that is short-term as well as long-term. They offer a range of returns. One such bond is corporate bond. A corporate bond is a debt issued by a company in order for it to raise capital. An investor who buys a corporate bond is effectively lending money to the company. The company gets the capital it needs, and in return, the investor is paid a pre-established number of interest payments at either a fixed or variable rate. Now, when the bond expires or reaches its maturity, the payments cease and the original investment is returned. So this is how you take exposure to some of the best companies of India Inc. without actually buying their listed equity shares. This way, you will be safe from the market volatility and even ensure that your capital is safe. But how can you invest in corporate bonds? You can subscribe to primary issues, but they are floated mostly through private placements and public issues are occasional. The second option is through bond houses or other intermediaries. They would show you the available inventory of corporate bonds where deals happen in sizes appropriate for high net worth individuals or the most affluent segment. The third way is to buy bonds from the exchanges, that is either from NSE or BSE or through a broker. But there are issues about liquidity, availability, and understanding the effective returns, that is yield to maturity at that price. The fourth option is online bond platforms. They showcase the available inventory of corporate bonds where certain aspects have been flagged off in a proposed regulatory framework by the SEBI in July 2022. Now, we'll come to that in just a bit. What is the minimum amount that you need to invest in corporate bonds? Well, the minimum lot size for the deals is usually 2 lakh rupees. The rationale for the minimum deal size is that bond deals are usually settled through the bond reporting and settlement platform of the BSE called the Indian Clearing Corporation. This platform accepts payments only through RTGS, which has a threshold of 2 lakh rupees. The issue with corporate bond market is that there is not much liquidity. Traded volumes in the corporate bond market is much lower compared to the equity market or the GSEC market. On top of that, transactions can take place in large lot sizes. The reason is that big boys like banks, mutual funds and insurance companies are the participants and not individuals. Dealing houses source the bonds from the wholesale market in large lots and make them available in lot sizes appropriate for HNIs. Given that there is not much liquidity even for bonds listed at the exchanges, screen-based trades are limited. Traffic flows through telephonic conversations in known circles as the market is confined mostly to a few square kilometers in Mumbai. With the benefit of technology, nowadays there are online bond dealing platforms floated by bond houses or associates. Being online, you can open an account anywhere, anytime. Coming to the SEBI proposal. The proposed regulatory framework by SEBI enumerates certain areas of improvement for online bond platforms. The market regulator will issue final guidelines post further analysis after taking into account public comments. Now, the proposed developments will seek to make the structure more robust. Now, the SEBI paper also mentions that only listed debt securities can be offered by online bond platforms. Therefore, market participants and issuers of bonds may be nudged towards listed ones. Net-net, with the expansion of the market, the number of issuers, the investor base and fleet-footed intermediaries, corporate bonds can be a good investment avenue. You can diversify your portfolio as per your needs and suitability. Hope this video gave you a fair understanding of the corporate bond market. For more such videos, stay tuned to Moneycontrol.